Hi, everyone. My name is Jay Skaalen, and I'm a partner at Osborne Partners and a member of our investment team. Given what has unfolded over the past several weeks, I'd like to take a few moments to share some thoughts on behalf of our investment team. First and foremost, we want to acknowledge that the societal impact from COVID-19 is leaving no one unscathed. It's an unprecedented time, and in one way or another, everyone's lives are being impacted. What we'd like to do is offer a brief overview of how the emergence of COVID-19 has impacted markets, take a look at where things stand today, and also look at how we're approaching this as an investment team. When COVID-19 first appeared in China, few people could have imagined that over the course of several weeks, this is a virus that would have spread across the entire globe. In response to the rapidly evolving situation, financial markets have reacted with intense volatility and at moments outright panic. In situations that present a wide variety of potential outcomes, markets often handicap a dire outcome as risk appetites dry up and investors seek safety. As it stands today, March 16th, most global equity markets are approaching a 30% correction and have formally entered a bear market, defined as a market that is sold off by 20% or more. This is the first formal bear market that we've seen since the financial crisis of 2008, although we have endured several periods of elevated volatility in recent years. Our approach, which I'll talk more about in a minute, has been consistent in each of these stints of volatility and has resulted in our clients being better positioning, exiting these periods of volatility than when they entered. In the current environment, it may seem hard to find a silver lining. As a team, we're not immune to emotional reactions, but we do our best to set them aside and take a pragmatic view of the current situation while keeping a sharp focus on what the globe may look like 1, 3, or even 5 years from now. With that in mind, we want to provide some commentary that will hopefully put the current sell-off in context and offer some clarity on how we're approaching it as an investment team. From February 19th, when the market set a new all-time high, through March 12th, the S&P 500 sold off by approximately 27%. This marked the fastest bear market in history, eclipsing the 20% threshold for a bear market in just 16 days. While the speed at which markets corrected is unusual, overall volatility in markets is not. Over the past 40 years, the S&P 500 has averaged an intra-year decline of nearly 14%, and despite this, has gone on to finish higher in 75% of those years. Additionally, while the market's recent 27% decline feels monumental, it is consistent with the median decline of 31% we've seen in bear markets over the past 150 years. One important distinction of this current sell-off is that it was triggered by a specific event, the emergence of COVID-19. Over the past century, event-driven bear markets have typically been the shallowest of bear markets, declining 27% on average and recovering the quickest, back to previous highs within 11 months. Examples of historical event-driven bear markets include the Gulf War of 1990 or the crash on Black Monday in 1987. Whether or not this current decline and eventual recovery will fall in line is hard to say at this point, but it gives us a framework on how to approach this current episode. One of the natural instincts for any investor in periods of elevated volatility is a desire to sell. Go to cash, ride out the storm, and re-enter the market when things are better. While we understand this urge, these types of decisions have historically proved to be one of the main reasons investors derail their longer-term financial goals. I'll offer the following as a cautionary tale. Over the past 15 years, the S&P 500 has resulted in an annual return of roughly 9%. However, if you miss just the 10 best days, your average return drops by over half to 4.1%. If you miss the best 20 days, your return would decline to a paltry 1.2%. Importantly, the best days often fall right around the worst days. In fact, 6 of the 10 best days over the past 40 years took place in the midst of the 2000 tech bubble collapse and the 2008 financial crisis. The point is, staying invested, as trying as it can be, has proved to be the most prudent course of action time and time again. The last thing I'd like to address is what actions were taken in this current environment. While each portfolio is unique, in many cases, we entered 2020 with elevated cash balances after we pulled back exposure to various investments. For many, now is a great time to focus on investments that have become increasingly attractive to long-term investors. It may seem like an odd or even uncomfortable time to make purchases, but in fact, these unique situations can present excellent opportunities for long-term patient investors. Many of our best investments in recent years have come during environments that felt similar to today. It is during times like these that we can demonstrate our true value we bring to our relationship with you. Over the past 80 plus years, Osborne Partners has been through many bear markets, and we will navigate through this one as well. Volatile environments like the one we're enduring today are where our multi-asset class strategy often proves its worth. Our goal is to remove the emotion from the process and to stick to our time-tested investment discipline. It has served our clients well in the past, and we're confident that it will serve you and your families well going forward. If you have any follow-up questions related to our investing philosophy and discipline, or specific questions related to your portfolio, please reach out to your portfolio counselor. We're definitely all here for you. Thank you very much, and everybody stay safe.